Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today, we're diving into a topic that's often overlooked by business owners, employee stock ownership plans, or ESOPs, and how they can serve as a tax-efficient, wealth-preserving exit strategy. Joining me is Sal Tirabassi, a fractional CFO with extensive experience in private equity, exit planning, and succession strategies. Over his 24-plus years in finance, he's worked in venture capital, private equity, and as a CFO of a high-growth company. His expertise in business transitions has helped family-owned and privately held businesses successfully navigate complex exits while maximizing financial outcomes. He has personally guided a $242 million business sale through both ESOP and private equity processes, giving him a unique perspective on when and how an ESOP makes sense. Through his firm, CFO Pro Plus Analytics, he provides virtual and fractional CFO services, helping business owners make sense of their financials and plan for their future. Sal, welcome to the show.
Hey, thanks for having me.
All right, so before we dive into the topic of ESOPs, can you just share a little bit about your career background and what led you to founding your firm?
Sure. I started my career out as a strategic marketing consultant, working with global 1,000 companies on corporate marketing and brand strategies. Then I went to business school and grad school for engineering, came out the other side, became a venture capitalist during the early stages of the internet a trend in like 1999, went through the internet bubble burst, did a lot of restructurings. I then left that partnership and joined a growth equity partnership. Over that period of time, I developed a lot of expertise in emerging company financing, restructuring businesses, raising debt, gained a lot of expertise in SaaS type business models and recurring type revenue type business models. After that, I became a CFO of a consumer services company that was focused in the finance space. And in 2024, early 2024, I started this business where I basically took all of my know-how and knowledge from private equity and building a whole CFO function in a high growth company, and sort of I package it in a way that can be customized to all the differences that exist across the emerging businesses that I work with. So no two companies are the same, different people, different business models, different technologies that they use. And we build a customized service to give them like a very, very high functioning, high quality strategic finance service that can carry them for a really long period of time as they try to grow and evolve their business.
Okay. I think that the topic of ESOPs is definitely interesting. I get a lot of questions about them from both the owner side and both the employee side as well. Maybe we can start with some of the basics. Can you just give the users a definition or an explanation of what an ESOP actually is and how it works?
Yeah. So an ESOP is basically an exit transaction for the owners of a business. It can be partial or 100%, and it allows the owners of a business to sell the equity in the business to a trust that is owned by the plan participants in the trust, who are essentially the employees. And a big question always is, well, the employees don't have the money to buy the business. And the way this is structured is that there's external financing that creates some liquidity or complete liquidity for the selling shareholders. And the trust builds ownership in the business over time. So they don't actually have to put money into the deal in order to get the transaction done. And I'll just say a couple of things about it that are important to know. So the structure is generally regulated by the Department of Labor. The ERISA regulations also apply, and the trust is basically like a single company 401k is the way to think about it, where the employees, when they're getting their ownership, it's in the form of a retirement trust. But instead of a 401k where you can invest in a bunch of different stocks, in this one, when you're given the shares and they're just given to you, you don't pay for them, it's shares in the company where you work. And the idea is that the employees build up an ownership stake in the business over time that eventually gets monetized for retirement. Um,
Okay.
so,
Maybe let's walk through an example. So let's say I'm a business owner and I have a 5 year plan where I want to say, okay, in 5 years I want to exit this business. Is that like a normal time to start planning for this, or is this something that needs to be planned over an even longer period of
no,
time?
I think that in general, as as a CFO, what I uh, always tell my clients is if you're planning to transact, you probably want to be planning about 2 years in advance.
Okay.
And obviously, things change a lot over a 2 year period. So it could become a rolling 2 year period if things go sideways on you. But for the ESOP, or if you were just going to sell to private equity, I would say if you're thinking about doing something like that, start thinking about 2 years before you actually need to do it. And you're really like going to go into overdrive on it about a year out. You want to be picking a banker to handle the transaction for you about a year in advance. And in the ESOP world, there are bankers who specialize in those transactions because they help you um, pick the trustee who's going to be representing the employees. Um, they also put together the debt financing that becomes the liquidity in the transaction. So either way, they're two totally different types of transactions, but either way, you need to be 2 years in advance and think about having an advisor work with you to execute the transactions.
Okay, so let's even go back to the example 2 years out. I say, okay, I'm going to do this. Is it at that point that I start doing what you're saying, working with the trustee, getting that ESOP plan in place? And then do I also, at that point, is this a choice for the employees? Do I go to the employees and say, I'm exiting, would you like to participate in an ESOP, or is this something that
Yeah,
they're blanketly
what ends up
participating in?
happening is you appoint an employee who is acting kind of like an employee representative to actually hire the trustee. So the
Okay.
owners of the business aren't going to hire the trustee because the trustee is not representing the owners, it's representing the employees. So an employee inside the business or a team can be assigned to go out into the market, interview a bunch of trustees, and pick one that you like. So that's something that takes time. Um, you're 2 years out. You also want to be starting to select an ESOP banker who can help uh, get the transaction together, find the debt financing that you'll need, and the banker will also help you hire a law firm that will advise you along the way. And you do want to pick a law firm that's got expertise in this type of transaction because it's got a lot of aspects to it related to ERISA and retirement and Department of Labor regulations. And a, a, a lawyer who hasn't done it before is going to need to do a lot of learning on your dime. So you're better off paying for someone who's done it a few times before.
Okay.
So
So let's even take a step back. So I got the trust, or I appointed the employee representative. They got the trustee. I found a banker, an attorney, and we're starting to move forward. What happens next? I get how do I get ownership into that ESOP plan? Am I gifting it to that,
yeah,
or
I'll talk a little bit about some of the steps. So now the trustee is your counterparty in the transaction. They are negotiating against you to determine a value of
for the
what the
business?
business is worth, so that they can put a value on it for the trust. You'll go through a due diligence process. the same way you would with a private equity fund. I mean, there are some variations to it, but they will hire a valuation firm that will come in and review your projections, your financial results, identify any risks in the business, and they'll give you a term sheet for acquiring the business with a price on it, and you negotiate with them. You get all your sort of deal terms set up, and let's say you've agreed on a transaction. Now what happens is you will sell your shares basically to the trust, and there's like this intermediary process there that I don't want to get into. It's a little bit technical, but just say if you're a seller, what you're going to do is you're going to get, for your shares, you're going to get seller notes that sit on the balance sheet of the company. Plus, you'll get some warrant coverage in the business that allows you to participate in the upside, but it's also compensating you because your seller notes are going to be at a very, very low interest rate. Okay, so now you've done the transaction. The trust now owns all the common equity. None of it is in the hands of employees at this point. It's just sitting like in limbo in kind of a holding account inside the trust, right? And the sellers have now gotten seller notes plus warrants. So now they're out of the equity structure. They own notes that are owed to them. And then if the company ever gets sold in the future and those warrants are worth something, they'll also get paid on those. Okay. Mm-hmm. And now you're at day zero where the transaction is done. The employees are now waiting to get shares out of the trust. So now what happens? Now you go, let's say a year later, and the trustee now has to issue shares to the employees, right? There actually are shares that can get issued to longstanding employees at the time of the transaction. But I'm gonna skip that. Let's just say on a recurring basis, nobody got shares. A year later, the trustee says, okay, it's time to value the business. They bring in the valuation company again, they value the business. And based on the mechanics of distributing the shares over a 30-year period to the employees, a certain number of shares come out of that holding account and go directly into the employee accounts. So okay. Jane Doe may get 10 shares and John Doe may get 8 shares. And the way their shares are determined is what is their percentage of wages as a percentage of the total wages of the business, capped at $280,000. So the cap follows the same rules as 401k plans. This is where ERISA comes in. Mm-hmm. Because, for example, if you had somebody making $1 million a year, right, they would drown out the equity distribution for all of the smaller, right, lesser compensated people. And ERISA always has these fairness rules that say anything you make above this amount doesn't count. You can't use that for your retirement benefit. And it's the same thing here. And the thresholds are all the same for all the retirement programs that are governed by ERISA regulations. So Jane Doe gets 10 shares, John Doe gets 8 shares. And the reason that they're different is that John's wages are slightly lower than Jane's relative as a percentage of all the compensation that was paid in that calendar year that they're calculating for. Okay. So now they have shares in their account. Those shares actually can have vesting terms on them. And that's all determined at the beginning of the process. As you're developing the relationship with the trust and the trustee, you come up with different rules that you're comfortable with as an owner for how the shares are going to vest over time. But once they're vested, they're owned by the employee and they sit there until retirement age.
Yeah, so you did mention earlier that it is a retirement trust. How does that work from the seller's perspective? Does that make any difference from the seller's perspective and like the tax consequence of this, or
Yeah, no, that doesn't really make that much of a difference it's sort of like, imagine if the New York City Police Department retirement fund came and bought all the shares of your business. It's really no different from that,
right?
right? It's a, a nonprofit retirement entity that now owns the shares. The only difference is that, like, if the New York City Police Department retirement fund bought it, they would own all the shares. In this case, because of how it's structured as a compensation scheme, most of the shares are sitting in limbo and they get distributed out over this 30-year period. Right. And by the
And
way,
so
it doesn't need to be 30 years, but it can be shorter. But typically that you end up in that 30-year range is my understanding. At least from my experience, it was 30 years. But and so
so
let
the
me talk to you about the tax stuff, but I'll let you ask your question.
oh yeah, we're probably on the same page. I was going to ask you from the employee side, what's the tax
Okay,
kind of consequence of this?
okay, so the employees, there's no tax consequence. It's when they take the money out, it's taxed at long-term capital gains because they're essentially owning. No, sorry, it doesn't get taxed at long-term. I think it gets taxed the way your normal distributions from your 401k would get taxed.
Like ordinary income.
Yeah,
probably.
ordinary income.
Yeah.
Yeah. Now, but the tax benefits to the company and to the selling shareholders are pretty important. So the selling shareholders, when they receive their proceeds, they can do what's called a 1042 exchange. And it's similar to how people roll over real estate gains into new investments and defer the capital.
1031 exchange.
1031.
Yeah.
It's similar to that, except you can only roll it over once. And what you do is you could just, as long as you're investing in a US C Corp, you could take your proceeds you can just go to Morgan Stanley or to Fidelity, and you can say, I want to buy, let's say you sold the company for $30 million. I want to buy and you get your proceeds, you say, I want to buy $10 million of Apple stock, right? That counts as a rollover for the owners. Not to mention, though, what's an interesting aspect of that is if you go into the public market, and there's a lot of other mechanisms that you can execute here, but I'll give you a simple one. If you go to Morgan Stanley and say, oh, I want to buy $10 million of Apple stock, guess what? They're actually going to give you margin on that, right?
Right.
So you actually don't have to invest the full 10 million to get the rollover protection. You can just invest the equity, the piece that you need, and then Morgan Stanley will lend you the rest.
Right.
And then all the money that's left over is basically just free to use for other stuff. And you've covered yourself for the tax deferral. Then let's say 5 years later you sell the Apple stock, you'll pay capital gains on that.
Right.
Right. Now the company, if you execute, you can do a partial acquisition by the ESOP, by the trust, or a full acquisition. Now this is kind of pretty simple to think about. If you do a full acquisition by an employee trust, which is a nonprofit, you are basically, they own all the equity. So all the profit that the company generates is state and federal tax free, because the owner is not taxable. So when you structure it as a taxable entity, everything that comes through the entity is basically tax free. So New York City doesn't recognize that, by the way. So in New York,
of course not.
If you have a portion of your business that's in New York City, you'll still end up paying New York City tax. But and I don't know what other jurisdictions that applies to, but federal, and I believe in almost all states, you'd end up being tax free. So now all of a sudden your business, if you're running a profitable business, you went from, let's say you're running a business that makes like 15% margins on 100 million of revenue. you were making $15 million a year of profit, and then you were paying 21% to the federal government, like 8% to New York State, and then you have your net profit, that all those taxes go away. So now you have $15 million that you can reinvest into the business, and do other things with. Now, the owners don't, that's not a dividend to the former owners, right? That's a dividend to the trust.
To the trust, right?
Or you can just keep it in the business and use that capital to expand your business or do, whatever. You can use it to pay down the seller notes, right? So there's a lot more efficiency in the system. And by the way, this is one of the reasons why the ESOP legislation is popular with Republicans and Democrats, because for the Republicans, it gives, business owners the opportunity to have long-term capital gains deferral and tax efficiency in this business that they're still running. But for the Democrats, it gives average employees in a business the opportunity to become owners, right?
So who is so actually, let's go back to the seller's perspective. So I guess one, you talked about, they get their proceeds, they can buy Apple, roll them over into Apple stock. How do they actually get the proceeds? Is that where that debt financing comes?
Right. So now let's go back to that. So now we let's rewind to, you did the transaction, the trust owns this holding pen of shares, right? And the seller now has seller notes and warrants. There's nothing stopping the company from going to a bank and saying, oh, I'd like to get a senior debt security in here, or to go to a private lender and say, I want to bring some debt into the business. This is where the ESOP investment banker helps you. So now you bring in, let's say you sold the company to the ESOP for $100 million. You have $100 million of seller notes plus warrants. And the bank comes in and says, oh, you're doing, you're doing $25 million a year of net income or of EBITDA. I'll lend you 2 turns of debt on that. So I'll lend you $50 million. And that's a reasonable risk for a bank, 2 turns of leverage on a 25 million of EBITDA. They put 50 million in, and you can take the 50 and pay down the seller notes on, like, within days after closing the ESOP transaction.
What are usually the terms of the seller notes in terms? Are they like usually 5 years, 10 years?
They're 30 years. They're
30
also
years, okay.
tied to that same schedule. The schedule of the notes is tied to the schedule of the share distribution, so that they're working in sync. Because the sellers, the shareholders, the employee shareholders are gaining shares over on a slow drip, and the seller notes, in terms of their own sort of amortization, are also kind of on a slow drip. But the seller notes can also just stay frozen and never amortize. And the only way you amortize it is with, like, new capital coming into the business. Or if the company makes a lot of profit, it could take that profit and pay down the seller notes.
And how does the owner, like, fully get out of the business if that's what their intention is?
There's 2 ways. You mean so you mean like fully exit?
Yeah.
Yeah. So fully exiting the business is, and you're talking about relinquishing management control?
I think both management control and getting fully paid for whatever that sale price
Okay,
was.
so those are 2 separate tracks, but getting fully paid is three mechanisms, right? Profit distributions that pay down the seller notes, and then also pay down the warrants over time.
Mm-hmm.
But that's a long tail process, right? You can accelerate that with debt financing, right? And then the third way is you could do the ESOP, and then you can sell the whole thing to a private equity company firm later on, and then just sell the whole thing. And what happens in that instance is the employees, the trustee always negotiates an acceleration of shares that come out of the holding account and vesting if there's a transaction to buy the whole business, right? Because the trustee is not going to represent the employees and say, "Oh, we're going to create this trust, and then you're going to sell it the next day, and nobody gets anything." Right.
Right.
So they build in an acceleration of ownership in the event of an overall exit. And that exit could be sale to a private equity firm. It could be an acquisition by another company. It could be going public. Could be another way to do it. So that gets you out financially. So just to summarize, like long process through profits, slightly shorter profit with profits plus debt refinancing, and then at any point, if you just sell the whole thing, you get out. Relinquishing management control is really up to the owner, and whoever's going to be giving up control. You could theoretically have a parallel path where you're handing the management reins over to some key people in the organization, or you're hiring an outside executive CEO to come in and run the business. So that those two things don't have to be connected. They can basically become, the owner can basically become a board member, investor, by bringing in a team to run the business as part of that process.
And who's I guess after the day zero, when the trust takes control of this, is the trustee essentially running
No,
the owner?
no. The in order to make it work, and I'm not sure how this was figured out, but the governance is still mainly driven by the original owners, right? I mean, they've sold for seller notes. They're owed a lot of money. The trust doesn't actually own a whole lot in the early stages of the years of the, they're basically getting like, the employees are gaining like 3% ownership over time. The rest of it is sitting in limbo in that holding account, which, by the way, whatever's in the holding account gets redistributed upon a sale too. So the owners get some of that back, right? Because the whole idea is this is a 30-year drip feed. But if some of it's never been allocated, that needs to be shared between the two groups, right? So the board typically doesn't change very much after the transaction, and the trustee does not typically take a seat on the board. At least in my experience, that was the case. The trustee is there to represent the interests of the employees, and that doesn't necessarily mean that they have to sit on the board. It's more like they're the appointed shareholder representative.
From the owner's perspective, when they're kind of looking at, okay, this is the different ways that I can exit my business, right? If we just take the ESOP versus just straight selling out to private equity, what do they have to, or what are the pros and cons of either approach? I can definitely see the ESOP from the employee side; it's definitely a good deal. But from the owner side, why would they consider the ESOP versus just selling out to private equity, if that is an option? Let's say.
Yeah, I think the equity rollover piece of it is a big deal. And if you do 100% trust, employee ownership trust that owns 100% of the equity, if the owners do the math on that, and they're maybe really interested in riding the value of the business over the long run, they can be in a very, close position and sort of make more money over time than they would in a private equity sale. But I would say the main driver is like you can use it as a way to diversify your wealth in a very tax efficient way without having to sell the whole thing.
Are there any types of businesses that this is, it's called, best suited for? And that's either like sector, industry, revenue, or even like number of employees at a firm.
I mean, small. It's a pretty expensive deal to do if you're not a big like a decent sized company. But I would say like if you're, and again, this is just my opinion. Like, I would say if you're, doing, 5 million or more of kind of net income a year, it doesn't really matter what industry you're in. I think it's really more an income driven thing. Like, do you have a profit and loss profile that allows you to finance debt in your business? Because ultimately, that's the liquidity that the owner needs to be able to exercise the wealth diversification and take what they own and then turn it into this tax deferred 1042 exchange. And you need profit to be able to do that, right? If you're like a fast growing but unprofitable software as a service company, I'm not so sure what you get out of it. You're basically introducing a bunch of interest expense into your business when you could otherwise be investing that in more customer acquisition.
Right.
But when you're profitable and now you're shielding that profit because you're owned by an employee trust, then you can really make the money work for you, right?
From an employee side, what happens if they, like, let's say they go through this ESOP, they're granted shares, shares vest, and then they leave the company, or do they sell do they have to sell the shares back
No,
to the?
you're in there's some instances where you will get bought out, and I'll go into that. It's really more when you're very small shareholder and you kind of left very early and you didn't invest all that much. There's a way to like keep the trust kind of clean and really like focused on the longer standing employees over time, so you can get paid out involuntarily. And these would be very small holders of shares, but generally you can't monetize it until you're at one of the thresholds for retirement according to the federal government's retirement ages.
Right. All right, Sal, that's all the questions I have for you today. I want to thank you for joining me on an episode of The Agent of Wealth and sharing much of your expertise. Before we go, how best can our listeners learn more about your business or get in touch with you?
Yeah, so my website is CFOProanalytics.com. I also have a blog where I write about finance and analytics topics, which is my last name.com, Tirabassi.com. You could easily find me on LinkedIn, and and if we do a lot of work, as I said, doing strategic finance for emerging businesses, family-owned, founder-owned businesses. ESOPs is one of the things that we have expertise in, but we do a lot of other things, and I'd love to hear from your audience if anything that I talked about is of interest. They're super interesting topics to talk about.
Definitely. Great. We'll include all that information in the resources section of the show notes. Thanks again, Sal, and thank you to everyone who tuned in today.
Thanks for having me.